All right, let's jump right in. Today, we are tearing down Origin Bancorp's Q1 2026 performance. We're going to unpack their recent earnings report, dig deep into those underlying financials, and uncover exactly what these numbers signal for the stock's future. Let's get to it.
So, let's kick things off with a pretty provocative question. Right now, major financial headlines are almost exclusively obsessed with mega-cap tech stocks and artificial intelligence. But under the radar are regional banks like Origin quietly building some serious, sustainable momentum. It's a fascinating corner of the market that honestly gets overlooked way too often. And the data we're looking at in this explainer suggests there is a seriously compelling story unfolding here.
To really grasp where they're going, we kind of have to look at where they started. Founded way back in 1912 in Chotran, Louisiana, Origin Bank has survived and adapted through over a century of wild market cycles. Today, they operate over 60 locations across the South, proving that deeply rooted, personalized relationship banking still has absolute staying power.
Here's our game plan for today. We'll start with the snapshot, move on to the Q1 report card, then break down the strategy, and finally, look out at the horizon.
Okay, part 1, the snapshot. Let's look at Origin Bancorp today. As of June 18, 2026, OBK is hovering right at $49.36 a share. But what's really notable here isn't just the number, it's the trajectory. Over the past year, the stock actually dipped to a low of $32.12. So what we're seeing is a stock that has rebounded beautifully, and it's currently knocking right on the door of its 52-week high of $50.35. That share price puts their market cap at roughly $1.38 billion. They represent a very solid, mid-cap regional footprint. Their strategic focus areas span Texas, Louisiana, Mississippi, Alabama, and the Florida Panhandle. And their bread and butter? Commercial and industrial lending, what we often call CNI, alongside treasury management and your traditional retail banking. Moving right along to part 2, the Q1 report card. Let's drill into these raw numbers.
Now, if you just glance at the top line, you might notice what looks like a slight sequential dip. Net income moved from $29.5 million in Q4 of 2025 down to $27.7 million in Q1 of 2026. Earnings per share similarly ticked down from 95 cents to 89 cents. But look closer at that bottom row. The underlying pre-tax, pre-provision earnings, or PTP, remained incredibly steady, barely shifting from $40.6 million to $40.2 million.
Just a quick aside on why PTPE is absolutely crucial. It isolates the bank's core operational strength. By ignoring accounting reserves for potential bad loans and stripping out taxes, it shows us the raw, unfiltered earnings power of the bank's day-to-day business. And let me tell you, that engine is running very consistently. And this right here perfectly illustrates that underlying strength. For a regional bank, you always want to see balanced growth. If you grow loans way too fast without bringing in deposits, you're going to run into liquidity issues. In Q1, Origin executed a perfectly matched 2.8% growth in both loans, adding $200 million, and deposits bringing in $234 million. That's exactly the kind of symmetry analysts love to see. All right, part 3, the strategy. Let's unpack Optimize Origin. So back in January 2025, CEO Drake Mills rolled out this initiative to essentially rewire the bank's DNA. It's built on 3 main pillars: maximizing productivity and efficiency, intensely optimizing the balance sheet, and maintaining their award-winning employee culture. For them, this isn't just fluffy corporate jargon. It's the literal operating system driving their daily decisions. CEO Lance Hall actually hit the nail on the head during their earnings call. He said, "This growth reflects disciplined execution, not opportunistic volume." Basically, they aren't just out there chasing growth for the sake of growth. They're strictly prioritizing high-quality credit and holding firm on pricing discipline.
A massive target of this whole optimized playbook is boosting a key metric known as ROAA, or Return on Average Assets. Simply put, this tells us exactly how efficiently management is using its assets, like the loans it issues, to generate bottom-line earnings for us.
Management is not playing it safe here. They've set a really ambitious target. They want to hit an ROA run rate of 1.15% or higher by the fourth quarter of 2026. And having already hit 1.11% in Q1, Drake Mills noted they are very well paced to crush this goal by year-end. Why does this matter? Well, shattering that 1.15% threshold would effectively push them closer toward elite top quartile industry performance. It's a game changer.
Which brings us to part 4,
the horizon. Let's look at Wall Street's forecast. We're actually seeing a super fascinating split in the forecast data right now. Traditional human Wall Street analysts are very bullish. A consensus of 66% rate OBK as a strong buy, with a 12-month price target averaging $50.33. On the flip side, quantitative algorithmic models like the Zen rating currently lean toward a neutral hold. It's a classic battle: human optimism about management execution versus strict, unemotional data-driven modeling.
A huge reason behind that human optimism? Just look at this massive expected jump in profitability. Wall Street is projecting an enormous 53% surge in earnings per share. They forecast EPS to leap from the current $2.60 right up to $3.99 by the end of 2026, and then just keep climbing to $4.29 in 2027. That kind of earnings growth absolutely outpaces the broader regional banking industry average.
If we zoom out and dive into the raw SEC filings, the dense paperwork that usually puts people right to sleep, it totally validates that confidence. The underlying margins are incredibly healthy. They boast a robust 6.06% yield on loans and a solid 3.71% net interest margin. The fundamental mechanics of their banking operations are clearly firing on all cylinders.
At the end of the day, if Origin Bancorp can keep up the strict, disciplined execution through their optimized Origin framework, they present a highly fascinating case study in regional bank resilience. They are expertly balancing growth with profitability, all while navigating a pretty complex economic environment. So, the question I'll leave you with is this. Considering all the momentum they've built, what do you think their next earnings report will actually reveal? Will they shatter that 1.15% ROAA target? Thanks for joining me on this explainer. And keep learning.